starting with what we have left last in the last class, I asked you to actually look into the factoring part.
Yes,
Exactly. So the different types of factoring. So were you able to go through it, and what did you understand by it?
yeah, ma'am. Factoring are two types, mainly recourse factoring and non-recourse factoring.
Okay.
In recourse factoring, there is an businessman, customer, and factoring agent. The factoring agent is main bank or financial institutes.
Okay.
Businessman sells the products or services to the customer, while customers are paying amount in terms or in payment or mm,
Okay, simple thing, right? That only one of the single most
there is a 80 or 20%. 20% is the fees is there. The risk factor with the businessman, and in non-recourse factoring, the risk with the factors.
Okay, cool. There has been somewhere almost very near to 80%. The way you need to put up, even when you're writing your answers in the exam, has to be crystal clear, right? Okay, so this is from my experience, even as a student or even as a working professional. One thing that I've understood is people does not have much time in order to actually, go through or actually listen to us. For that matter, they'll be like, hey, you know what? If there is a types of factoring which is asked, they want a straight away answer to it. And with that as an understanding, or with that in the mind as a background, what we can imagine or what we can attempt to make or answer this particular types of factoring is one being the recourse one. So in the first, the way you even represent in the exam is mention, if only there is a types of factoring which is asked, kindly mention what a factoring process or a factoring is in a max to max a line or two, so that will just give an idea, okay, this person knows about factoring. And the next thing is list out all the different types of factorings and write what you need to be writing actually distinguishes, so this is a thing and this is this type of factoring. Now coming back to the different types of factoring which is there, let me just go through each one by one. Okay, first one is the non-recourse factoring. See, the option of recourse is something that you need to be explaining if you're explaining a non-recourse factoring, and even for that matter, a recourse factoring. So what's this option of recourse? It is the option that is given to you in terms of having, or not given to you. I mean to say, in the transaction of factoring, is the option available with the factor that he can go back to the person who has sold the bills to him and ask that if in case of a default, there is a recourse option available. So which means to say, if there is a point when that particular bills does not, whatever the purchase bill does not go hold good in future, or it does not get paid, he can always go back. So that's the definition of a recourse factoring. Let's read it this. Under this type of factoring, the bank purchases the receivables on the condition that in case if there is any loss arising out, or maybe turning out to be a bad debts, that will be borne by the company which has taken the factoring. So which means to say that if a company A has taken a factoring option and the bank has paid some amount to him, in case that particular whatever the invoices does not get paid, in that case the bank has an option, or the option of recourse, to go back to the company and say that, boss, pay me the money which has gone back to me, right? So that's one. Then the non-recourse or factoring is the dead opposite of it, which means to say that the risk factor or completely is transferred to the bank or any financial institution who has funded that particular factoring, and there is no recourse option available. Now, with this as an example, what you can do is, considering when you're writing even in your as an answer in your exam, you can actually include two of the these two particular definitions and put them into an example and say that, imagine there is a bank, the same example that I gave you, you can write it in that way and you can distinguish their recourse option and non-recourse option. So which means to say that you do not have to write an example separately for each of them. You can include or combine, considering there is a lot of similarities, except that it is completely opposite to each other. So that's about recourse and non-recourse. Next is maturity factoring. This is that factoring where actually the cash advances are not paid at that particular time. I would probably rather say that this is not even a factoring, because every person with an intention why they would go for a factoring is because someone, in order to convert the credit sales into a cash sales, right? So, but here nothing happens. A factor is appointed. He's a person who becomes responsible to collect the bills, collect the money towards the bills, and just pay it to the, customer or the person who is appointed that factor. So ideally, I would say it's definitely not a factor alone, but definitely it is there. It is one of the factors. So you have to just remember that in that way. Next, advance factoring. What does it say? Under advance factoring arrangement, the factoring provides an advance against the unallocated, uncollected, and undue receivables to the firm. Very simple. It's one of the characteristic of factoring is that the entire point of having to, provide the money against the uncollected or a future bills is itself factoring. So that is what is mentioning here. Next, undisclosed factoring. Here, it's a simple way. Imagine I'm a company A, and I have actually sold the goods to you, and I'm not telling the information that I have appointed someone else, or someone else is responsible to collect the bill from you. And that sort of a factoring arrangement is called as an undisclosed. So, which means to say that the person who's supposed to pay the money to the company who has got into the arrangement of factoring, that customer or that particular receiver of the goods or maybe services is not aware of the factoring arrangement. Next, invoice discounting. No much of a difference, but let me read it out to you. Under this type of factoring, the bank provides an advance to the company against an account receivables and in turn charge interest rates from the company for the payment which the bank has given to the company. Okay, so this is like this, right? Instead of deducting charges, or maybe what will happen in the invoice discounting, I guess it's not invoice discounting. Is it how is mentioned in even in your this thing, even in the material? Or am I reading it wrong? I was just looking at the scanner actually. Is that the way it's mentioned in your syllabus?
No.
Let me just check that. How is it mentioned there? It is mentioned as invoice discounting only. Okay, cool, understood. Fine. Simple thing. There will be a factor which gets involved. Of course, the money gets paid. And what happens is to the money that is being paid as a cash advance, there will be a certain percentage of interest which is get charged. So, which is, it is a coupled, how do I say, it is a characteristic of factoring and also a characteristic of term loan or a credit facility arrangement where the interest is charged upon the money that is provided to you. Mostly in these cases, I have seen it. Actually, the kind of amount that gets deducted as a discount is very less because there is an amount of portion which is called interest, which will be charged upon it. So ideally, there are about 95% to about 98% of the money, which is, which you owed for the company or the bill that is discounting, that is paid to you. And a small portion of an interest will be charged against that particular amount that is given by the factor. So you mean to say that it's a combination of both term loan and also factoring arrangement. So that is invoice discounting. Now, I'm sure we have understood the different types of factoring. But as I already been telling you, see, it's the different way or is the explanation that you provide to an examiner is what becomes important when that particular person is actually correcting your paper. So always try putting out technical words. One, here in this particular example, I'm just trying to give you is the option of recourse. That is a technical word. And the coupling of interest rate to, and also the factor in case of an invoice discounting, that is a technical word. Using of technical words like these and also giving certain examples are very important and relevant for your examination. So hence always keep this in mind whenever you're writing. Put your explanation in such a way in writing that it is easy for someone who's actually correcting your paper to understand, and it's straight cut and clear, right? Are we good so far?
Yes, ma'am.
Cool. Awesome. So our next topic is, it is the loans or advances against the securities. Very common. I'm sure this is the most common thing that is being done. It could be the loan that is given against properties, or the loan that is given against even securities like shares, debentures, for that matter, any other valuable security, even gold loans. Everything comes under loan against securities. So now let's understand what is it. I'm going to share my screen. Okay, so we understood this. Cool. A quick overview of the benefits of loan against security. As we already know, it's a simple thing. A person is giving a loan to you against a security that he has already. So which means to say that imagine it is a secured loan. Okay, it's definitely not an unsecured loan. Mostly considering NBFCs or even NBFC MFIs, various other agencies like this actually provide unsecured loans. So they don't actually ask for any collateral, but loan against security, the collateral becomes very important. As I said, the collateral security either could be commodities, valuable commodities, which has a good, fetching price in the market. Could be gold, could be silver, could be properties, could be various different things, right? So that's one. And the second other important characteristic of loan against security is there is a interest which gets charged, and the interest is apparently a little higher in case of a short-term loans. In case of a long-term loans, this gets reduced. So now let's go ahead and actually understand what are the different benefits or advantages of loan against security. Loan against security is an overdraft facility that you get in return for the pledging of securities, such as mutual funds, life insurances, or various other things. Definitely, we are not restricting only for the mutual funds and life insurance. Anything which has a value in the market which could be sold is a security. Next, it provides the benefit of current account while letting you pay the interest only on the amount. See, the best other advantage of it is, imagine this happens especially in the LAPs, which is loan against properties. What is this properties? Which is the fixed asset. Imagine, you have a particular home and that house will cost about 70 lakhs. And you are in a requirement of approximately maybe 20 lakhs or 30 lakhs or 40 lakhs. Let's assume 40 lakhs is the amount that you want. So now you go to the bank and say that, boss, I have a property. I want a loan worth about 40 lakhs. And the bank will say, okay, you get the property documents. What will happen is, first, bank will assess the market value of that particular property. That's one. And the second thing what happens is, along with assessing the market value of the property, it sees that, okay, if there is a market value of about 70 lakhs, it tries within good margin of about, it gives about maybe 65 lakhs or 60 lakhs based on the assessment and the credit worthiness. And then it say that, boss, I will deposit, which means to say that it gives you a limit of 60 lakhs in your account and say that, boss, you can withdraw the money from this particular account within this particular period of time and only pay the interest on the utilized amount and not on the entire limit. So which means to say that if you are, given a limit of about 60 lakhs and you only want a loan of about 40 lakhs, so only on the amount that you have taken, which is 40 lakhs, you are supposed to be paying the interest and not on the entire sanction limit or the credit limit that is available to you. So that's the advantages of loan against security. So it is the flexibility which it provides to you in terms of having to take the loan. And the second is, it is more faster because bank already knows that you have a security. It just checks the market value and goes ahead and gives it, and it will be provided in your account. The limit will be provided in your account, and it is hassle free because you can take the amount whenever you want within that particular period of time and pay only on the amount that is you have taken and not anything on the entire sanction limit, right? So that's the advantages associated with loan against security. Are we clear?
Ma'am, yeah. If loan sanctioned and if loan credited in our account, what is the benefit for the interest? What we use it for?
Sorry, I did not understand. So,
if the loan is sanctioned for 40 lakhs, I am used only for 20 lakhs and remaining 20 lakhs in my account only.
No, it will not be in your account.
Okay.
The limit is there in your account. That's all.
Okay.
So 20 lakhs, why will that person block his money? No banker. So it's like you have been given 40 lakhs and you only want to use 20 lakhs. So you can only take 20 lakhs and you will only pay the interest upon that particular thing.
Okay.
So it's the limit availability. That's all. Okay. Fine. So that's a very simple concept, very common done sort of a loan, which is the loan against securities or LAP. LAPs are very common in the market. Yeah. So I'm sure you're also aware a lot of people take LAPs. Actually, recently I was hearing, I don't know if this has to be told, but let me tell you a very interesting factor. What happens is, have you heard that whenever the bankers give the loans, they actually ask you to take insurance?
Yes, ma'am.
Right. So one of my colleague and me were discussing about this, and apparently my colleague took an agricultural land. Okay, so he planned on taking an agricultural land that was maybe worth about 20 lakhs. Okay, and of course there was a property, and against that property only they took the loan. And considering they wanted 20 lakhs, so everything was sanctioned, everything was fine. But now the glitch came into this picture where he told, that particular banker told, no, why don't you take an insurance policy? Okay. Considering maybe the premium of that insurance policy for that entire 5 years was coming up to about 1.5 lakh. Okay. Now, this person was okay about it. He was like, anyway, insurance is always good because in case of an uncertainty, your family is not responsible to pay the loan. At least it gets covered up like that. But maybe, I don't know, he tried finding a way out. And the banker told that if in case nothing will happen, sir, this particular 1.5 lakh money will be paid to you without any interest or anything. And that too after some 10 years, it seems. So that was the terms and conditions of the bank. Okay. Then what happened? So considering my colleague was a little clever, what he did is he had an LIC policy, which was worth about 30 lakhs, it seems.
Okay.
So what he did is he asked the banker saying that, boss, why don't I use the same insurance policy and you keep this insurance policy as a pledge against the insurance that you're asking me for?
Okay.
So in case if something happens, I will make you the nominee. So only one thing that he did is he changed the nominee of that particular policy. From whatever maybe his parents, he changed the nominee to a banker. So in case if there is anything which will happen, the money will go to the banker instead of the respective family members. Understood?
No loss and no money again.
Exactly. So I was very impressed with this because I'll tell you how. One, first of all, you are not having two insurances, correct?
Yes, ma'am.
And he's tried utilizing the same insurance policy which he already had.
Okay. Yes, ma'am.
And the only thing that he did is he changed the nominee. Okay. So all in all, even for a banker, he wanted a security against his money. And also, even for him, he did not wanted to invest that extra 1.5 lakh and then get it paid without any interest after 10 years or whatever 15 years that banker told. Considering he had only taken the loan for about 7 or 8 years, he didn't want to do this. So that was a very good arrangement. So this was actually a part of LAP only. So he had taken this LAP loan that I told. So I felt like it was an interesting thing. So just keep it in mind. If in future, if something you have to do something like this, you can actually use this as an opportunity and use the existing insurance policy instead of having a new one and separately paying for it. Okay.
Okay.
Awesome. I just recalled it. That's the reason I told. Nothing relevant, of course, but it's something that happens in the market. Now let's go to the next topic, which is import finance, buyer's credit and supplier's credit. Before this, I wanted to show you a video on export credit. Okay. Let me just stop sharing my screen for a while. Yeah. So I wanted to show you a video on export credit. I really felt this to be very interesting because this was released by DGFT, the Department of Foreign Trade, which is responsible, exactly, which is responsible. And they've done a very very easy video on how an export finance works and everything. Of course, I'm going to explain it, but this is a very interesting 5 minutes video. So let's watch it. And if there is anything that you want to tell after that, you definitely can add up. And then I'll just try explaining the bits and pieces from that only. Very interesting video. Considering it was from the DGFT, I wanted to show it. Okay, give me 1 second. I'll stop my video. You can see the screen, right?
Yes, ma'am.
Okay. Can you hear to it?
Export and post-export financing.
Just 1 second. Let me just increase the. Is the volume okay?
Yes, ma'am. Okay.
Okay.
Quality should be.
Niku has got a confirmed export order and has now started manufacturing her export items. However, there is considerable working capital cost involved in the process and Niku does not have enough money to cover all the costs. Not to worry, we explain here how the Government of India and banks can help her cover her costs. Finance can be extended to export at the pre-shipment stage in rupees as well as foreign currency. Here are some of the ways. Packing credit. Working capital finance can be extended in anticipation that the borrower would receive payment on export of the goods. This loan can be taken not just for packing but also for purchase, processing and manufacturing of exports. Niku needs to provide an export order or a letter of credit as proof. There is an interest which is charged on the packing credit given. Further, the firm must pledge its stocks or other advances against the credit given. Post-shipment finance. Post-shipment credit is an advance granted by a bank to an exporter like Niku after export shipment. It is always given against the proof of shipment of exports like the export declaration forms prescribed by the RBI. The advance is till the date of realization of the export proceeds. Advance against duty drawback. Duty drawback is a refund of duties like GST paid on inputs in the manufacture of export goods to the exporter. Banks can grant advances to exporters against their entitlements of duty drawback. The period of such advances is up to 90 days. Shipping bill copies containing the EGM number needs to be produced to the banks for advances. Advance against scrips. As explained in earlier video, exporters are issued benefits by DGFT called MEIS and SEIS scrips under the Export from India Incentive Scheme for their goods or service exports. These scrips are freely transferable. They can be pledged to other parties in return for cash advances. Such transactions involving scrips are usually between individual entities and not with banks. Forfeiting. A forfeit is a French term meaning the right to relinquish. Here, Niku can relinquish her right to a future cash receivable to a third party called the forfeiter. In exchange, the forfeiter can provide her an immediate cash payment. The disadvantage to Niku here is that the value of this immediate cash payment would be at a discount to the actual receivable value. The advantage here is that any risks and responsibilities for collecting the debt are passed on to the forfeiter. Before forfeiting, NICU should go through the specific RBI circulars on forfeiting and ensure compliance. Factoring. Factoring is similar to forfeiting in concept. It differs from forfeiting in details as follows. Firstly, factoring is done on trade receivables of short maturities. Unlike forfeiting, in factoring, the buyer has legal recourse in case of non-payment and the entire risk and responsibilities are not transferred. Thirdly, in forfeiting, the export bill is purchased by the forfeiter, while in factoring, the invoice is purchased by the buyer at a discounted value. There are specific RBI circulars on factoring that NICU should read through. Interest Equalization Scheme. Lastly, the Department of Commerce or DGFT offers the Interest Equalization Scheme. Under this scheme, the interest rate charged by banks on pre- and post-shipment credit finance is reduced by 3% per annum. This reduction of 3% is covered by the Government of India to support trade entrepreneurs like NICU. For more details on packing credit, etc., NICU could approach a private or public sector bank.
Okay. So were you able to follow?
Yes, ma'am.
How was it?
Super.
No, it was. I really felt this to be actually very interesting one. Considering the sorry?
If it is visual, it's visualized right, ma'am. It is most helpful to understand the recognize.
I know, right? I know exactly. So yeah, I guess that was the good thing about it, is because everything was automated, everything was procedure wise, and it kind of gave out a lot of inputs on things. Now let's start with each of them. Okay.
Yes, ma'am.
1 second. Okay. Yeah. So, of course, you have seen there was something which was predominantly said in the video was this packaging credit, right? I'll tell you what you can remember, especially about an export incentive or even an export financing, is something that we know, is in case of a good balance of payment, or for that matter, there is a good income or a generating income for country, is especially an export, businesses, right? So every given point of time, the government always wants to, improve the exports, considering it gives a lot of money to the, especially as a country. And there's a good fiscal state of us in front of the world scenario. With that as a background, now let's understand the different types, or predominantly the two types, which the kind of a credit which get utilized in export credit. What happens is, one, the pre-shipment. Next is the post-shipment financing. Okay. So pre-shipment financing, by the name itself says, it is that finance which is required right from acquiring the raw materials to having to produce that finished goods. And to the stage of producing the finished goods is where the pre-shipment financing comes. Could be working capital finance, that's what you can say, and also the a little long-term finances, which is included even to acquire machinery, assets, and various other things. Now, the post-shipment finance, again, on the other hand, is the finance that is required from the sale of goods to the actual realization of the value. If you see, every export is not a cash sale. It is definitely a credit sale. Today, the exporter will export something today, and the grace period or the period of credit will be about 30 days to 90 days, and post which only the amount gets paid. So with that as a scenario, something that you always have to remember is, just 1 second. Sorry. Sorry. So where were we? Considering it's a post-shipment financing, there is a grace period which gets involved. The person will not be able to get the money for the goods that he has sold today. So he definitely have to wait for this 30 days or 60 days or 90 days, whatever the grace or the credit period that he has given. So this is where the export financing comes into picture, especially in the post-shipment scenario. And both of these type of scenarios, which is pre-shipment and post-shipment financing, will come either the money can be provided to an exporter in the rupee denominated terms, which mean to say that everything is based out on rupee, or either it could be a foreign currency denominated loans or any sort of an advances, or for that matter, even a deemed export is something that they call, which mean to say that any amount, any goods or services given to an SEZ zone or a zone which is treated as an export itself in India instead of having to export it to another country. That's when this deemed export incentives or deemed export advances comes into picture. So now, one of the questions that would probably come to you is there was this concept that you saw called forfeiting, correct?
Yes, ma'am.
Very similar to what we saw even the factoring. I'm sure even in the video, they said few of the differences between both of them. So a predominant difference is that, again, the recourse option, what we studied in case of a recourse option, right? In case of forfeiting and factoring, in forfeiting, the entire risk is transferred to a person who is the forfeiter. He's the one who gets responsible for the actual purchase. What he does is he actually purchases the bill and becomes responsible for the money owed to an exporter. In case of a factoring, this definitely amounts to a discounted value. Then the option of recourseability is there. Then there is a legal option of going to a court in case if there is no, or the loans going bad and everything. But forfeiting is something which is more of a riskier term. Not really recommendable, but still, institution who has a good, how do I say, good advantage over taking more risk, and someone who wants to do this will actually go and get into this. Now, let me just show you one of the picture. I've just tried explaining forfeiting in a simple manner. And 1 second. Okay. Can you see this?
Yes, ma'am.
Okay. I've just, I've just kind of done like a, image sort of a thing for you. What is it is, if you can see, there's one exporter who gets involved, right? And what he does is he finalizes the term with a foreign importer, right? Because if we become an exporter, the other person becomes an importer, right? The person in the other country. So he finalizes the transaction terms with him. Then based on the finalized term, he shipped the goods to the foreign importer. Then what happened? He does prepare the export documents because there has to be a proof of having some shipping and also the terms and conditions and everything. No? So exporter prepares the export documents and then gives it to a foreign importer. Now, what a foreign importer does is he gets the same export documents co-accepted by a reputed bank in his own country. So the arrangement happens that other bank who's co-accepting these documents is the one who's telling to an exporter that I have looked into the documents and the foreign importer will pay the money to me and I will give this money to you. So that's the arrangement that the reputed banks comes with both the foreign importer and the exporter. Now what happens? Final document, which is the avialized document, which is accepted by the reputed bank in the foreign importer's country, will be sent directly to exporter. Then, considering the exporter wanted to do this entire, forfeiting concept, what he does is he sends these documents as a proof of, ship of goods or a proof of sale to an importer and get the money from him. One of the three important features associated with the forfeiting is, one, there is a deduction of commitment fee. What is a commitment fee? It is a commitment that he's taking in order to take up the bills directly to him. Then, of course, he does a little bit of a discount. And then there is a documentation fee which gets in. Because if he's actually taking that final documents, he definitely has to do some sort of a due diligence associated with it. So that's what he does. Next, without recourse. As I already told you, there's a concept of no recourse which is involved in the forfeiting concept. And that is another important feature. Next, another important feature or the entire reason why the forfeiting is done is to convert the credit sales to a cash sale. So which means to say that a credit sale which had a period of about 90 days suddenly turns out to be a cash sale and the money comes to an exporter even before the 90 days period. So exporter going and finalizing the terms, shipping the goods, then preparing the export documents, then getting it co-accepted by the importer's respected bank, and then the final document reaching him, and he then forfeiting this with the forfeiter and getting the money is and converting the credit sale to a cash sale. The entire concept of this is the forfeiting. Are we clear?
Yes, ma'am.
Okay. Hope this entire, picture and explanation was easy to understand, because I've seen in your syllabus there was a lot which was given about forfeiting. So if you want to just remember this particular picture. And even if you're preparing the notes, normally the questions that gets asked to me by students is that, ma'am, how do we, sorry, my bad, 1 second. Yeah. So one of the most common questions that gets asked to me by students is that, ma'am, how do we prepare notes? And how do we remember the entire 2 or 3 pages into a page of half or page of even maybe 1 or anything?
Yes.
So this is exactly the way you have to be remembering. See, if you remember, if you have looked into that entire, whatever the diagrammatical representation I had done, it's easy. It's something that is remember worthy, and anything which comes as a forfeiting, that picture will come to your mind and you can explain the process. So always try remembering any concept in a process flow, in a mind map, in a sort of a story thing, because that helps you in remembering the concept instead of don't remember points and all. At the end of the day, all that will not help. Okay, so that's a little bit about forfeiting. As I already told you, export finance predominantly is divided into pre-shipment and post-shipment. And this can be either rupee denominated or export, even for that matter, export incentive based one, or the foreign currency denominated. So that's about export finance. And under that only the forfeiting concept is also covered. Now let's move into import finance, which we have it in our slide. Okay.
Madam, where should we get the pledging of assets? Why should we
Sorry?
get pledging
Sorry,
of assets?
Sorry, I wasn't able to hear you. Tell me.
Pledging of assets.
Mm-hmm.
Where should we get the in slide? They said the pledging of assets. So what is the assets we should be pledged, and why should we pledge the assets?
Which slide was this?
Yeah, video you showed me, right?
Uh-huh. Pledging of assets was there, told.
Yes, ma'am.
So in what background? Sorry, my bad. I might have missed out. What was it exactly?
Pledging of assets for the taking of loan.
Mm-hmm. Oh, okay. Listen. Okay, so this is another important concept. Definitely, it's not covered in your syllabus. I'll tell you what is it. Good that you asked. What happens in an import-export business? There's definitely an exporter would have certain assets for himself, right? And not only along with, see, what happens in an export finances, any amount, any cash advances or any sort of loans that is given, it will be against the projected or the expected cash flows that will come from a sale, correct?
Yes, ma'am.
So imagine that today A is someone who's, or otherwise imagine you, Gnan Prakash is planning to, or who has already sold the, goods worth about 30 lakhs. So the expected amount that is expected is about 30 lakhs, and the person gives the loan based on that. Okay. What happens is there is this pledging of security, which is another coupled up thing with the projected one. How do I put it? It's like these guys are asking you, boss, okay, you're telling me that your worth value or the goods that you've sold is about 30 lakhs, which is there in the invoice also. But along with your invoice discounting or along with the invoices that you have provided to me, please give a collateral. Please give a collateral as any sort of a security, which is a part of your business. So what exporter does is they either give the collateral or security as their plant and machinery, which is there, considering if they are into manufacturing business. In case if there is a services, they try giving the intellectual properties as, the collateral. So along with providing the invoices, they also give a collateral security or a collateral, a sort of a amount of any asset, which could be the plant and machinery or anything associated with their respective business. So, which means to say that the risk factor, ideally, why this is asked by a bank or financial institution is to reduce their risk. Means if in case, God forbid, if something goes wrong and the invoice does not get paid, they always has this collateral that they have taken from us. Understood?
So the meaning of scripts.
Okay, the scripts. Okay, I'll tell you what. Scripts is an incentive scheme provided by DGFT. Okay. It is that scheme which is about 2 to 5% of the value of the goods that has been sold, or the free on board or free of value of the goods. So this is that percentage where it says that, boss, because you're into an export business, this percentage is the script or a document that the DGFT is giving to you and saying that you can use this document to pay any taxes like GST, or pay any duties, which could be export duty, or pay any sort of a related payments to the government, instead of paying the money or the free cash from your pocket. So it is an incentive provided by a DGFT, which is about 2 to 5%. And what it does is, let's take an example. You have made a transaction about 10 lakh worth. Okay. So 2 to 3% is about how much? That's about, I don't know. How much is it? That's about that's about 20,000 or something, right?
Or 1 lakh, ma'am?
No. For 10 lakh.
10 lakh into 5% is 50,000.
Yeah. So 2 to 5%. So let's assume it's about 20,000 to 50,000. Okay. So what they do is, imagine they're giving about 3%. That's about 30,000 of the worth of value of entire 10 lakh that we actually have made the goods sold. So that 3%, 30,000 script, the document or like any sort of an arrangement or a certificate form of a thing that they give it to you and say that in case if you have to pay any duties associated with your export, could be GST, could be export duties, or any tariffs that you're supposed to be paying to the government, you can pay and submit this particular, pay through this particular script instead of paying the value in cash. So which means to say that the money that goes from the account or from the pocket of an exporter gets reduced, because he will have this particular certificate in hand, and he can say that, okay, imagine maybe there is a value of about 50,000 worth of export duty that he has to pay. For that, not export duty, normally there is nothing like that. Import duty is the most common duty that we learn. Imagine there is some sort of a duty which gets involved in that export. If he has to pay that, what he can do is he can give this particular script and say that, please take a value of 30,000 and 20,000 he can pay in pocket. So ideally, it's an intensifying scheme to the exporter to do more business and to reduce the out-of-pocket expenses from his own pocket in paying the duties or in paying any sort of a taxes to the government. Okay?
Okay.
So it's like government is taking the responsibility. You mean to say, if you saw that there is one interest equalization scheme which was there as a part of this video, right? Whatever is the remaining interest, or in order to come up with the market interest, the government takes the responsibility of actually, paying that interest to that bank. Imagine, say that as per the market, the bank is giving about 10% on a 10% interest rate, and government wants, in order to, promote the export business, government wants them to be given in that 7% interest bracket to the exporter. The 3% risk or a 3% baggage the government is taking. So similarly, government is only taking the baggage of this 30,000 or 3% or 2% or 5% of whatever the free on board value goods, and saying that, boss, okay, anyway, the money is supposed to come to me. Instead of you paying me 50,000, let's only take 20,000 from you, and that's 3% whatever I've given, you can always utilize. So it's like government giving an incentive scheme. That's all. Okay.
Okay.
Cool. Awesome. So where were we? We were export financing is done, factoring is done. We were supposed to discuss some on import finance. Predominantly import finance, as you saw in the slide, is divided into buyer's credit and supplier's credit. Okay. What happens in the buyer's credit is it's definitely how an export business wants some sort of a financing. Even a person who's importing from another country definitely wants financing. So buyer's credit is that where an institution, which could be an overseas institution, or for that matter, an institution in India, would give a money to an importer and say that, boss, you can take this for the value of goods that you're taking, and then pay this in a certain period of time. So give me 1 second. I'll try showing if it's possible, or otherwise I'll just explain it. A simple diagrammatic representation I've made is that, wait, let me just show. I guess my handwriting would not be really visible enough in this particular thing, but I'll explain. Imagine there is an import buyer's credit, and there is an importer, right? And there is an exporter. Okay. So exporter is a person who is there in the other country, and importer is a person who is in our country. So two important features which forms a part of buyer's credit is, one, there is an advance which is given by the bank or a financial institution. It could be an overseas or it could be from India. That's one. There's a conversion of a credit, purchase to a direct cash purchase, which means to say that maybe that if that particular exporter from another country is trying to give me a grace period of about 90 days, what happens with this loan is I'll be able to pay him on first day itself, on the day when the actual import was made to me. So there is a conversion of a credit into a cash purchase. That's one. And the second thing is, anything which is done, any sort of an import that is involving in case of financing of these import should be as per the DGFT guidelines. So if mean to say that anything which is not allowed as per DGFT is not supposed to be financed under buyer's credit. So that's one example, or one type of import finance. Now coming to another type, which is the supplier's credit, or an exporter's credit, or something that you can call. Here what happens is, instead of a bank financing the loan or giving the loan to you, simple thing is, what an other person does is, the person who is giving the goods to you, and you are whosoever you're importing the goods from, he takes certain amount as a down payment from you. That's one. Second thing is, he gives you a period about 1 year to, coupling up to 5 years, 10 years also, to repay him the money, right? So it's like, instead of a bank giving a credit to you, supplier who's supplying the materials to you himself will give a credit. This only happens when the supplier who's supplying the goods to you is very sound. He has a pretty predominant business around him, and he has a risk factor, or he has a risk accepting factor which is involved with him. So that's a supplier's credit, and this is a buyer's credit. Buyer's credit is when the buyer directly takes the loan from an institution and then pays it to a supplier. Supplier credit is where supplier just takes the down payment, certain amount of down payment of the goods that is being sold to the importer, and then gives a sufficient amount of time to repay the other remaining purchase value, right? So that's import finance, which is supplier's credit and buyer's credit. Are we clear?
Yes, ma'am.
Awesome. Now let's go to Islamic banking. Have you heard anything about Islamic banking?
Actually, no, ma'am.
Okay. It was very intriguing concept to me. I had actually even studied Muslim law when I was doing my law. Okay. There are a few principles which is forming a part of Muslim culture, that a lot of which is in a very, it has a very intrinsic and also very moral value to the life. I'll tell you why. If you see even Islamic banking, definitely I have not seen much of the questions which is asked from it, but I'm just going to give a little brief about Islamic banking. Islamic banking does not work similar to a simple conventional banking, which means to say that how a banking works. It's like I'll give you a loan, I'll charge you some interest, you pay the money to me, and then yeah, that's all. So that's a simple funder, right? Banker, let's assume Kotak Bank accepts the deposits from the depositor, and he'll give the further loans to another people who are in requirement. He'll charge a specified percentage of interest, and whatever in order to run the business will take that particular interest income as the main income of it. Simple conventional banking. But in Islamic banking, two core principles that they believe in. One, they don't give the money to any businesses which involves any speculative activities or anything which is immoral. Could be gambling, could be even any alcohol business, could be something that is associated with, maybe, how do I put it? There were a lot of things. Give me 1 second.
Out of halal, man.
No. I have put in examples. Actually, I saw that in I was reading some article. One is the alcohol business, drugs, war, weaponry, and as I already told you, gambling, high speculative businesses. So that's one. The next other principle that they have is they don't charge the interest, okay, to the money that they have given to you. So instead of that, what they do is they want to become a co-sharer of your profit and losses that is arising out of any amount that they have invested either in your business or with respect to the goods or services that you have purchased from someone. So which means to say that, see, banks, what they do is they will not bother in our businesses. They'll just give about 50 lakh loan and they'll be like, do whatever you want to do with your business. I just want my interest income. But Islamic banking does not believe in that concept. They don't believe in the concept of interest itself. What they do is they believe in profit and losses, sharing of profit and losses. So instead of just lending the money, they try becoming the co-sharer in the profit and losses that is arising out of the businesses which they have invested in. It could be for the goods purchase, it could be for the service purchase or anything. So that's the two important characteristics which gets involved in Islamic banking.
Ma'am,
yeah.
Islamic Bank gives loan to all the Indians for their fraternity only.
No, it's respectively, especially to the Muslim community.
So what is the meaning of speculative here as per Income Tax Act, as per company?
See, I'll tell you what, if you actually apply the concept of Islamic banking to India, it is not actual banking at all, because every banking institution in India has to be regulated by the Banking Regulation Act, correct? So as per banking, the two important features is, actually there is one of the wordings which is very nicely put out in our syllabus. Let me read that out to you. How Islamic banking is not applicable to India. They've given it in a very nice way. I was reading it. See, the Indian banking laws will have to be amended in order to incorporate the very concept and provisions relating to Islamic banking. The reason being is that, for example, the Banking Regulation Act requires payment of interest, which is against the principles of Islamic banking. So which means to say that our Banking Regulation Act actually believes in the concept of interest, and the Islamic banking does not believe in. So if in case we have to introduce Islamic banking to India, there has to be a change or the amendment which has to be going through the Islamic banking. Next, the Act also specifies banking to mean accepting deposits of money from public for lending or investment purpose, which means to say for the further lending and investment, thus excluding within its ambit the instruments of Islamic banking that promotes profit and loss. Which means to say that they never believe in the concept of lending. They don't believe in the concept of charging an interest for that lent amount. They only believe in the investment and sharing the profit and loss, which is not as per the Banking Regulation Act. So ideally, if you see, Islamic banking concept in India is not acceptable. If they want to introduce or if they are supposed to get this banking system in India, they should ideally change a lot of provisions or beliefs of them, and then only can introduce Islamic banking in India. So that's one of the reasons that Islamic banking is not very predominant in India. It is predominant in Egypt, few Arab countries, and everything. So yeah, so that's ideally, if you see nothing relevant to India, this is just given for your understanding purpose. Okay.
Okay, ma'am.
Awesome. Cool. If you see, like, see, we're all studying about Indian laws. We should be more, how do I say, relevant with the Indian laws. So hence, this is not really applicable. Maybe they just wanted to give you the concept, understanding what an Islamic banking is. And with that as a concept, they've given. Awesome. Now, Islamic banking is covered, import financing is covered, export financing is covered. Now we have next topic, which is the CMA data for availing the loan and deposits. Have you heard anything pertaining to the CMA data?
No, ma'am. The fraud is first time.
Okay, awesome. Literally, I'll tell you, coming from the background of raising funds day in and day out from banks, you have no clue. Banks just irritate us to the core with funding requirements. Every data that they ask is for all the CMA data that we are talking about. Okay, now let's understand what a CMA data is. See, CMA data is actually called this whatever, a data which is given or, provided to the bank in order to avail any sort of credit facilities from bank. So the most important, as I already told you, in order for a bank to give a loan or any advances on a cash credit limit to you or any credit facility to you, it would want certain basic details, and the details based on the three categories that we have mentioned here. One, current year estimate. Next, past 3 years data. Another one, projected data, which is mostly till the repayment. What do we understand under each of this? Let's go in detail. Current year estimate is the estimate or a data belonging to that particular institution. Assume you're an NBFC. Let's take an example of my own company. And I am actually going and, planning to take a loan of about 50 crores. So a bank, in order to provide or compensate to the CMA data, under the first heading, what they'll say is, they'll ask me, how am I doing or how my current year is going on. So this could include what is my collection efficiencies. So if you understand what a collection is for an NBFC, which means to say that I've provided a loan to someone, what's the collection percentage that is there on a monthly basis? So that's one. And it could be, even for that matter, what is the capital which is available to you? What is the ratio of your debt to the equity? And various existing information, how your businesses are doing. Everything pertaining to the current year is a current year estimate that they'll ask. Next is the past 3 years data. That is mostly sought out. The reason being is that they just want to know how the company has run the business in the last 3 years, which is the most recent years. And based on that, we'll just have an understanding that how we have grown eventually as a business. Next is the projected data. So assume you are planning to have a loan, or I'm planning to take a loan of over 2 years tenure. What they'll do is they will ask the data and ask you that, please give me a data which shows that how your business can perform in the next 2 years. What are the services or the products that you're offering? And what is the estimated value of sale that you will be making? And what is the estimated value of the amount that you're supposed to be raising from the market? All this is the projected data. The reason why they've asked you the projected data is just that they want to be sure of the money that they're giving to you, is because they don't want you to go default, and they don't want your loan account to become a NPA to them, which is a non-performing asset. So hence, the CMA data predominantly classifies into current year, previous years, and projected data. So that's about the CMA data. Now, there's this concept, in order to, while assessing the CMA data itself, there's this concept of operating statement or a profitability statement that these bankers will prepare in their own mind or with the data collected from us. What they do is they classify the liabilities and they classify the assets based on the data that was provided from us. And then they will bring up and they will assess or make a statement showing where we are standing financially in terms of having to pay back the loan. So which means to say that they will assess our credit worthiness. So in order to assess our credit worthiness, the statement and the classification that they do with the liabilities, the assets, with the data that we have given to them is the operating statement or a profitability statement. Just like previous class, the way I have, provided to you a short understanding or a short exercise for you to do. In your syllabus, there is a classification which is given to you under liabilities, which is long-term, short-term, current liabilities and everything. Even under the asset side, there is a balance sheet item given to you. You go through it, and if you don't understand, mostly everything is studied by us in various, financial subjects that we have studied so far in the executive and even foundation syllabus. Tell me which is that headings that you did not understand, and tomorrow we will take that. Okay?
Okay.
Awesome. So that's a little bit about CMA data. Yeah.
Here, data means only the financial data or any other company related data?
See, I'll tell you what CMA data does include non-financial data, but to only certain extent, like capital structure, what's the funding projections. Again, at the end of the day, they all come down to financial information only. But there's something which involves as a managerial or a technical feasibility information. We will definitely come to that in the last slide of us for today's session. Considering you're asking, let's go to that slide directly, and I'll explain you now only. Okay. Okay. So as you already told, in case of understanding the credit worthiness of a customer who is trying to avail the loan, the banker will always go by these 4 important factors. 1, technical feasibility, economic feasibility, financial feasibility, and managerial feasibility. So what do we understand by a technical feasibility? Let's imagine that you're a company and your company is into, selling of certain goods. And that particular goods is something that is invented or actually have, is very specific offering that you're making to the market. Very special one. So considering you're offering a special product to it, there is definitely some sort of a technical advantage that you have over another people, right? You're not having a provision store. You're just having, okay, let's assume, I'll try giving you a very real life example, okay? Okay, so have you heard of this? I'm sure you've heard of the company called Paytm, correct? Yeah. So Paytm, the entire concept of a Paytm came into picture, or the reason why they went on to become a market, leaders in their, fintech space is because Paytm had that, technical advantage of integrating most of the services which were offered by different people under one roof, correct? If you go to Paytm, you literally can access from buying the gold to having a bank account, to actually making a transfer, to shopping. So the technical advantage they had is their tech built. So I don't know to what extent you understand this, but for a company, especially technological companies, their tech build is the most important advantage. And this is the most intangible asset for them. Every valuation of a tech company or a tech-based companies gets dependent on this technical feasibility, which means to say that the kind of upgradation that they're making to the existing technology that they're using, and what is their future preferences, how they're actually using that particular technology to serve the society, and how well they're planning and everything. So every valuation of that company regularly on 6 months basis or on maybe a yearly basis, anytime there's a valuation done, they always see the tech build of that company. So coming back to our example, or coming back to our concept understanding, imagine you're a customer. Maybe let's take our example Paytm only, and Paytm is planning to raise the money from another bank or financial institution. The bank will see their tech build and the technical concepts associated with the product that they are offering. And with that as a background, they check various features like what's the tech build of that particular product, how well it has been provided to. Considering there is an involvement of a bank transfers, is the tech build enough? Is the tech build having enough security features so as to protect the actual transfer in a right manner? Does the customer data is not getting leaked? All this is the technical questions that the banker will ask. Now coming back to the economic feasibility, The economic feasibility mostly depends upon the worth or the value in terms of money. So which means to say that imagine Paytm has been taking a loan about 50 crores for one of the project. So what happens is the bank will assess if in case if the project goes into features, what is the economic sustainability of that project? Will the project will be able to produce enough money, and will it be able to, get the money that is given to it as a loan, and will it be able to survive in the market, as all the economic feasibility which gets checked. Now coming to a financial feasibility, what happens here is everything pertaining to the project cost is assessed. So imagine we are taking a loan of 50 crore in our example, and that particular 50 crore is given to Paytm specifically to build a particular product. And what happens is, of course, every project comes with certain respective cost and respective, finances which gets involved. Every cost that is involved in that project, and what is the, working capital cycle, and what is the, overhead cost of each particular, manufacturing unit, or for that matter, each particular process, everything gets evaluated in financial feasibility. Now, coming back to our last managerial feasibility, here the identification of a core team is done, which means to say that I am considering we are giving a 50 crore loan. Now you guys come and tell me who are the people who is behind this particular project, what's your core team, what is their experiences, and what is the value addition that they can bring to the project. They all do this just to understand that how well this project can perform. So a bank is very, very, very secure. They're very risk averse. They always take the steps in the most calculated manner and then only provide the loan. So which means to say that from the factor of understanding the technicalities involved in the project, to understanding the economic or a standing which it will have once it comes to the market, to understanding the each overhead cost of that particular project, to understanding even the people who's involved in the project, only after knowing all this, the bank will give the loan. Okay?
Okay, ma'am.
Awesome. Cool. So definitely all this will go through when a particular bank is giving the loan to you. But technically, CMA data is the data which predominantly gets featured or gets dependent on the financial information. So as we have already discussed, to the current estimate, to the previous year data, to the next financial year, every information is asked. So that's a little bit about, bank or taking a loan from the bank or financial institution.
Madam.
Yeah.
Madam, how can we get the projected data for the up to the repayment?
How can you get matlab? I do not understand.
Okay, ma'am. How for understanding?
Okay, so imagine this, right? You have, I told you already in the example. Give me 1 second. Let me stop sharing the screen. Yeah. So imagine this situation that you have is that there's this 2 years repayment that I told you in the example also.
Yes,
and what happens is, considering that particular company is into the business of, maybe let's take an example, simple business of giving certain goods to the market. Okay. They're into some manufacturing and they're producing the goods and they're selling the goods. So they're planning to take a 2-year loan from that particular bank. So what happens is, the bank will ask that particular person that, boss, in this 2 years, give me the details about how much you're planning to produce, how much you're planning to, what is the value of the money to which you're selling this particular products that you're planning to produce, and what is the cost associated with each of them, and what are the reserves that you're making, what is the, what do they call? What is it? Yeah, it's a balance sheet item, no? They make, they make provisions. Sorry, my friend. Yeah. Okay, so what is the provisions that you're making towards the loans or towards any sort of an, irresponsible or maybe for that matter, unforeseeable events? What's the provisions that you're making towards it? And how much is the loan capacity or a credibility that you have towards in order to repay that particular loan? So everything from what's going to happen in the next 2 coming years, what is your business decisions, to what you're planning in terms of producing, to what is the value that you're expecting to, get from that production of the goods, to when you're planning to sell it, when is your season, particular time, everything, every plan B or a plan A of that projections is asked from the bank. The only reason they do is because they just want to understand that if something happens, that the bank is in a secure position, because at least the bank knows what will happen till the end of their maturity or a repayment period. So all these are the data which is predominantly asked. Working with a startup, I can tell you, we provide, which is projected plans, plan A, plan B. Plan A doesn't go well. What is your plan B? What is your business propositions that you have for the next 2 years to come, 3 years to come, 5 years to come? You don't believe people even ask their business projections till 7 or 8 years. So that's the expectations that people who's planning to put the money will ask from you, right?
Okay, ma'am.
Awesome. I hope I answered your question.
Yeah.
Okay, cool, awesome. So we have another 2 concepts, which is working capital assessment, or a working capital methods of how a working capital is provided, and project finance. So what I'm planning to do is I'm planning to take this up in the tomorrow's class. Sorry, this class had to be a little smaller, shorter in terms of the duration. Actually, like I'm not feeling pretty well today. So I just wanted to finish few of the important topics. So this project finance and then working capital cycle or methods, we will take it up. Will probably take about 20 minutes or 25 minutes. So we'll take that up in the next class. And then I'll try finishing the letter of credit, considering anyway the bank guarantee is kind of mostly covered. I'll take up even a bank guarantee pertaining to the exams very specifically. So that's one, letter of credit, bank guarantee. I guess that's mostly about 2 chapters that we were planning to complete. Here and there, maybe 1 or 2 topics which is there that I'm planning to also take up. So my plan is that I'll cover this particular topic also tomorrow. And I'll take up that next chapter, which is there pertaining to the bank credit, the bank facilities or anything, non-funded facilities, that also will take up and we'll cover. Okay?
So tomorrow 12 o'clock.
Yes, correct. Tomorrow is 12 o'clock.
Okay.
Sure, yeah. Fine then. Awesome. Have a very good Saturday evening and eat well. So don't stress around too much. So considering you've cleared your CS executive very recently, your exams is supposed to come in December, right?
Yes, ma'am.
Oh, that's really nice. So you're planning to take up all the classes? Sorry, you're planning to take up all the subjects, or how is it?
No, ma'am. I am planning group 1 and group 3 once at a time. Yeah,
Okay.
group 3 will be much easier. I asked my seniors and most of the members. They said that group 3 is much easier than group 2.
Correct,
So,
agree. It is the same group which has open book and all, no?
yes, ma'am.
So which has 2 open books, right?
Yes, ma'am.
Okay, so
Mostly I'm thinking the insolvency and bankruptcy subject. If it's not going well, I'm going with banking laws and regulations.
banking laws is nice actually. And you have a lot of question papers, previous year question papers you have. So I'm not suggesting you to be taking that, but always choose a thing which has a lot of previous years for you to, like previous year question papers for you to have an assess.
Actually, I want to take tax laws, but from the new attempted members, it will be cancelled.
Oh, is it? Tax laws was also a part of it, is it? Okay, sorry. I did not know about it. Okay. So but the subjects have been increased also, right?
Yeah, ma'am. 7 subjects and forensic audit and tax laws will be cancelled.
Considering you're into CA, it's actually a little easy for you, no?
Yes, ma'am. Direct tax laws will be the cakewalk for me.
Understood. Yeah, but it's okay. I guess that's fine.
And multidispensary case studies, I should be taken by after June. I should pick the subject. And now I am going with governance and risk management, drafting, and your subject. This capital funding.
Okay, so listen. Tell me what are the subjects that is associated under each, each whatever groups.
Yeah, first one in first module, governance, risk management, and compliance and ethics.
Governance, risk management, compliance and ethics. Okay. Oh, that's okay. That's one paper. Huh. Then,
Drafting, reading and appearance.
okay, understood. Then,
Tax laws and practices.
oh, that's in the first
Module.
module, is it? Okay. Okay. So third one.
Third
Corporate-
one is capital funding and listing. And second is multidisciplinary case studies. And third one is optional subject, any of the season, maybe banking or insolvency and tax.
Okay, one of the tips that I can give you is considering the open book, whatever you're planning to choose, what you do is you invest about like on an average, because of course you have exams in December, no? So invest about maybe 1 or 2 hours every week. Maybe take it up on a Saturday or a Sunday. Invest like 1 hour each on Saturday and Sunday. And first do an easy analysis of each first syllabus once,
Yes, ma'am.
and then just read through the things. Okay, always read open book as a newspaper in the first reading of yours. Then mark whatever is the difficult ones, or if you're feeling that this particular topic seems to be a little difficult on a first reading of yours. So first reading should always be like a newspaper reading. Then in, I guess, considering you're only investing about 2 hours a week, maybe by May or something, you'll be able to cover your first reading, correct? No? So if you do that, you'll have one analysis of how it will work. So then in the second attempt and all, try making notes, try making sticky notes and paste it near that, whatever it is. Because what happens in open book is you have book in front of you, but you won't be able to answer it in a easy manner. Because there are so many things which gets involved, right? You don't know what to write, what not to write. So that filter should only come with the sticky notes and everything. All that is just a tip that I'm just trying to give. But you do this, it'll be really helpful. Okay.
What should I consider? Should I want to read, ma'am? The first thing, that ICSM module.
First is ICSM module that you have to go through only.
Because I have the practical example, even 2 to 3 attempts, I lose the ECL subject. So I studied some others books, and even I didn't get the 40. I didn't reach the 40. So the last, where 1 year gap will be came right now. I have only 2 subjects to complete. So I have read the module book, the very old module book. Even I get 56 marks in the ECL. Even I didn't. It's the last paper. I didn't make much complicated that, but I get 56 marks. So module book is very helpful to me.
No, that is true. And the second thing is, no, that's what I keep telling everyone, is that out of the module, what you do is, put that entire syllabus of maybe 20 pages of whatever chapter into a page of 2, 3, or max to max 4.
Yes,
so always put that entire 20 pages into that 2 or 3 pages for better revision, because that helps a lot. I'm sure. See, it's stupid, right? I know, I've been a student, I understand. Reading before, how do I put it? Reading the day before the exam gets too difficult, because there is so many things that is there. You're writing and you're coming from the exam. I guess now you guys have some breaks, no, in between.
No, ma'am. If you are continuously exams with the 3 modules, there is no gap. And skipping up.
So, otherwise, if you're taking up some one module, you'll have some break, no?
Yeah. Skipping the module, is there a gap?
So imagine, oh God, I remember my worst. That was a nightmare for me. Oh Lord, that 9 days or 10 days that I'd given, it looked. Yeah, I know. Like, I've given 7 days, of course, for this executive, and that 9 days, maybe that professional. Good Lord, I had no clue what I was doing. It, like, after a point of time, everything goes like, everything that you're reading is like bonkers. Like, everything is going over the head. Because, like, your mind is not capacitated towards it, right? Like a continuous study of that 400, 500 pages every day. You're going, you're writing, then again on the next. See how much you're prepared. That 9 days also is very important, no? So I guess, good that you have taken a decision of first and third group. That's actually what I did myself. I did not take second group. At that time, what happened was the structure was like 3 groups, and then again I had like 3 days or 4 days time, and then another 3 days I had to write. That's one. And the second thing is, I guess that's pretty much about it. but try concentrating, always try making notes, because notes is what gets you really helpful in the day before, because we have very limited time. We have to go through every chapter. Hardly, there will be minimum of 20 chapters for each subject, which is impossible for you to study in that 8 or 10 hours. I guess you'll hardly get 8 or 10 hours, no?
Yes,
Before the exam. Yeah, that becomes really hard. So try accommodating, put that everything in the notes. Like how you told, don't read from multiple books. It's of no use.
yes, ma'am.
Reading from multiple books actually will confuse you more than anyone in life. So read it from module, put it in your own notes, have an own understanding. If you really want, maybe if there is one or two, chapters which just gets really difficult, you can always ask us or whosoever you're taking as a faculty. They might help you with some material. That's always there. But do your own notes, because only when you write your own notes, you'll be able to remember it very properly. So yeah, that's a thing.
Actually,
Sorry?
I want to make my career in capital markets or any, like you, ma'am, in the funding or in the capital markets. I completed my few of my NISM modules too.
That's nice. Okay.
Yeah, I completed my three NISM modules
Mm-hmm.
regarding the capital market.
So how was it? Yeah, sorry, I really wanted to do this for the longest time, but yeah, I've been like, that's also because I've been like really too much into the workspace and all of that. I haven't really had time, and I was doing my LLB also, so that was like a full-time thing that I was doing. So how long is this NSIM thing, Like I just wanted to.
Oh, you should have to register with NSDL, ma'am. There is one option, NISM examination. You have to register there. There is 27 or 28 modules is there in the total NISM. You have
Okay.
to choose what modules you have to write, and you have to make the payment there.
So how much on an average each course or each module is?
1,500 per module, ma'am.
Oh, okay. That's not that much, no?
There is a times you have to choose the time and center, and you have to make the online examination and immediate result.
Okay, that's nice. Okay.
They give
That's
online tests also.
Okay, fine. So that's nice, yeah. Good. Thanks for telling. Like how on an average, how much time did you take to complete modules?
Yeah, ma'am. I in 45 days I completed the 3 modules myself.
Oh, that's really nice, no? Okay. At least worst case, yeah, tell me.
I am in the rural city right now, rural town. I have to travel some tier 1 city to write the NISM modules, because in the tier 2 also, tier 2, tier 3, there is no exam centers for this.
Oh, is it? Okay, okay.
I have to choose.
So which normally do you choose? What city do you choose?
I choose for Hyderabad only, ma'am.
Okay. How far is Hyderabad to your place?
300 to 350 kilometers.
Oh, that's a lot. No, that's not very near. Okay. Okay. That's nice. Yeah. Good to hear that you're doing it. Let me also check, considering I'm a little free now, at least till the end of March.
For you, I think the capital market subjects are the cakewalk for you.
Yeah, like day in and day out, we see it, no? Oh Lord, the ratios. You have to, but it's a very fun thing, considering you're very interested to be a part of this, no? I'm telling you, this is really fun. Like, I enjoy my work, actually. Every day, the work that comes to me has all the complexities which gets involved. I keep telling our team, actually, like every possible nonsense you will add to that transaction and get it to me. But that's how it is. Only when you actually do something more complex like this, that's only when you'll understand and you'll actually build yourself as a better professional, right?
Ma'am,
So
I want to ask a question, but are you satisfied with your job as a CS in your NBFC? Means mental
yeah,
and
sure. Sorry, what is your question?
Yeah, mental and physical and financial.
Yeah, I guess I am actually. My role in the company, or at least my role in the job, has really evolved. Let me tell you the kind of way I have evolved myself. I joined as an intern, got into secretarial team. Then for some reason, sorry?
Secretarial team.
Exactly. Right. So I was working under CS. I was trained under CS. Then because it's a startup, then again, it went on to be that I actually had to, I had like 3 bosses initially at my internship itself. So I was reporting to compliance head, I was reporting to secretarial head, I was reporting to finance head. So all 3 works I had done under each of them. Then came a part where the funding was there. Of course, secretarial team was a predominant part of a funding process, which is equity funding. Got involved in due diligence, did due diligence every 6 months, or maybe at least on an average 2 or 3 times a year. I've done that. Then again, also on the other hand, was moved to compliance team and did a lot of policy framework makings, various things associated with compliance. Considering I was into, these guys are mostly into RBI structuring and all of that, have done that part. Now, because probably again, as a I've been telling, or maybe even I assume that I was very focused in terms of, like, I was very goal oriented. To a certain extent, secretarial work actually felt a little laid back to me, at least in terms of compliances. So yeah, I guess got an opportunity to work with capital markets team, went on to capital markets, and I have already had got an understanding of how the equity works. So wanted to understand the debt. Now, from just doing the transaction to the structuring of deals, I guess the role have really evolved actually in a way. If you ask me in terms of satisfaction, definitely I am, because I guess even the changes that has gone through with what I joined as an intern to what I'm doing today is nice. And also one pride that I take in myself is that what I'm doing today as a CS, not everyone is doing in the market. So if you see normal CS, most of them, when you go and meet few people, they're always into compliances, they're into board meeting stuff, they're into something which is a little common secretarial work. So they wouldn't have evolved themselves into understanding a lot of it. But always try taking a niche area, that area which is not really explored by a lot of CS or professionals in your own industry, because that will always give you as a fair advantage against another person. So that's, yeah, I guess mostly, hopefully that answers your question.
So what is the complex situations you faced with the managing directors?
Okay. I'll tell you, I have founders who are very young. Okay. So they're very impatient. So sorry?
Most youngers are the impatient.
Yes, exactly. And also, also on the other hand, I guess one good thing that I see in them is that they don't come with a notion of that a young person can't do this. So one of the advantages that has worked out, especially in the startup for me, is that no one in the company thinks that, hey, you know what, this cannot be given to this person because this person does not have enough experience. In startup, everyone is all new, processes all new. They were like, okay, fine, whoever wants to do it, let them do it. Times. So that's one. But coming with the complexities I've faced, I guess, yeah, it's there. Yeah, I have a boss, I have a manager who has a lot of anger issues. So I guess I'm
not asking in that area, ma'am. So if a manager or if your boss asks any decision or any suggestion, you have to give within seconds or within minutes without any late.
See, I'll tell you what, something you have to actually look into this particular aspect is that always give the answer which you're very sure about, right? Yes. That's one. And if you're not really sure, if you want some sort of an understanding based structure, please try using some time for yourself. No one is asking that you're an expert or anything. Definitely everyone knows that things are changing, especially law is changing. So take your own good time to just analyze the issues. Say to them, I'll get back to you if you're not really sure. That's one of the things that I can always say you, even when you go out and work in a professional setup, always answer which you're very sure. If you're not sure, even 90% you're sure and 10% you're not sure, frame your words in such a way that, hey, these are the factors that I'm sure about, but these things I will check and get back to you. Only then go. Because I have seen people uttering something nonsense, then going back and saying, hey, you know what, this is not applicable and all of that. Never do that. That doesn't really make sense. And one of the other feedback that I can give in terms of having to manage board of directors or MDs or someone who's a founder to a company is be very specific. And considering you're a subject matter expert, they always will see you as a subject matter expert. Talk only to the niche area that you are an expert of. And if there's any other, connected questions also which comes to you, try answering more in a generic way. And also, if something that they're expecting from you and something that you don't know or you're not aware properly, always ask for enough time and get back to them than blabbering out something, which you might repent in the future time. So that's about it. Okay. Cool. Yeah, fine then. Awesome. So,
how may I ask doubts? Any medium of?
They should have ideally created a group in Telegram. So who is the person you guys are normally talking from Academy?
I'm talking with Alok sir and other lady ma'am.
Akshita, is it?
I don't know name. I
Okay.
make my all numbers with Alok sir.
Okay. So how about we do this, right? I'll actually ask Akshita. Akshita is the person who kind of manages things in the back end in terms of arranging the timelines, and she's someone who's responsible to conduct the entire classes and everything. I'll ask her. Ideally, the group should have been created. Worst case scenario, I will ask her to create it. But until then, you can definitely ask questions, or you can write it down and send it, or just keep it for a while. And whenever in the next class, you can give it to me. Yeah.
Madam,
that also.
Small suggestion. How may I choose my articles? Is in a company or in articles?
What's your goal is very important. If you want to work in a company, please go to company.
Okay.
So that's very important, because there's a lot which you can learn from a company and which you will definitely not learn from a firm. But considering you have an ambition of doing a practice, firm is something that you should go for. So with what you have, what's your ambition for the next future years to come is where you have to see yourself. And if you want to really grow a lot, you want to learn a lot, try joining small companies, startups and all of that. If you want a very steady, peaceful, not so hassle-free, so actually hassle-free job, then join an MNC.
Okay.
Yeah, sure. Awesome. Yeah, thank you. So I'll see you tomorrow in tomorrow's class. Yeah.
Okay.
And 12 o'clock it is, and we'll complete that, whatever this topics that I discussed.
Okay.
Should be okay to complete 2 chapters, so which is good for like 3 days. Yeah.
Okay, ma'am.
Awesome. Thank you.